Greetings, everybody. Happy Halloween and welcome to this week's Top Down Review. This is Jeffrey Scott. My email address is hgsidoc@gmail.com, and I welcome you to this week's session. Markets fall despite earnings with election, COVID, and economy in focus. Late-breaking news. We just had Boris Johnson announce that he's shutting down non-essential businesses in England. So is this February and March? Here we go again? Well, if it is, I'm a lot better prepared than I was then. Hopefully not, but we shall see. As always, this is for education purposes only. I am a doctor, not a broker. I have none of the licenses needed for me to tell you what to buy or to help you with a transaction. I am independent. Any software that I use or support or suggest are because I use them and I like them. I get no fees paid to me by anybody. Trading involves risk, and you alone are solely responsible for any decisions you make. From time to time, I will do some organized teaching, teaching people what I've learned. I call my training Be Your Own Guru. And what I mean by that is, as you can see here, a lot of well-known and lesser-known individuals. I find smart people and I learn from them. And then I try and become a better trader by doing continuous learning. I suggest you be your own guru and find smart people for you to follow. Read them, go to live meetings, purchase their packages, their videos, and take responsibility. I did. What I need on my desert isle, I have a lot of programs. I need TradeStation or Thinkorswim, and the programs I use with them, John Persons, Lifetime VIP, Dr. K's tools, Q tools, among others. I use Hgsi, predominantly aftermarket. I know that Ron Brown really has wrote the book on during the market use of that tool. I use EdgeRater to automate some of the analysis that I do. And again, I call out specific products, but I'm not doing it because I'm being paid to. I never take any money on anything you purchase. And if there was an offer, all I would do is tell them to give it to you as a discount. Thus, at the end of the day, I am an unpaid volunteer, and this is just education. HighGrowthStock.com is the website. Again, I have no financial relationship. Free 30-day trial gives you a trial without a credit card under investing strategies. You'll see my name and others and hundreds, if not thousands, of movies. Stock patterns are cyclical. I think this is a very important line on the top. High growth stocks will go up like rockets when the market's leading, but they'll fall like rocks. And didn't it feel like rocks hitting your portfolio on Friday and this week? So clearly, at least on the big cap tech, we've entered stage 4 fear. Now, whether this is going to be just a bump along the road to higher highs or something worse, time will tell us, but we'll talk about some of my thoughts as we go. Since I feel that we are in this period of time, I did buy puts and sell calls, shorted stock, and have been playing with contra ETFs or shorting non-contra ETFs. Not a time to be going shopping as far on the buy list, although I had to buy some APPS after it pulled back this week, and I'll probably get burned on it. I'll have things on short leashes. Friday's sector review, despite, as you can see here, the NASDAQ down 253 points or 2.24% on the futures, there's still a lot of green there. So I think the more general markets perhaps held up better than big cap tech, but boy, did big cap tech get clobbered. If we take a quick look at the major indices, and here I'm using Thinkorswim, I'm going to maximize them and just give you a sense of where the futures are. And I like the futures because there's trading before and after markets, overnight, etc. It's less gappy. It gives me more a sense of where we've gone and perhaps where we might be going. E-mini futures traded down on the day, less than 1%. It's interesting because as I look at this, it almost looks like this bar closed higher than the prior close, but obviously it didn't. But that's a reversal bar. And if I wanted to be bullish, I would say that on fairly decent volume, and frankly, better volume than on the prior day, we have a green candle. Now, I don't believe the market's reversing here. I think we still got some risk, but I might put that in the positive commentary. We're still above the 200-day moving average, and we're right in the range that it reversed last time. If I look at the NASDAQ futures, similar down, not quite to where it's reversed in the past. It's not a green candle, doesn't look nearly as strong, and you could see it's come well off its highs. If I look at the Dow, sitting right on the 200, clearly a place 2 days in a row where you might expect to see support. If I look at the Russell futures, 2 dojis in a row, are we putting in a bottom there? You know, all that's very optimistic. I may be hopeful that this is happening, but I'm also respectful of the fact that this is a tough market and could go down quite a bit more. The VIX, you know, for a day where my portfolio got hit, as did the NASDAQ and all the major futures to some extent, on Friday, the VIX actually had a reversal day. I had the wrath of having a very large VXX position and calls that would expire at end of day Friday and trying to get out of them. And even though it's not a totally illiquid market, boy, it's tough because all those market makers know that you're just going to keep lowering your price. And then lastly, you got the dollar, which rallied a little bit last week, maybe surprising with the new homes being weak, or maybe with the shutdowns in Europe, we're the strongest place again and people are going to be buying our dollars. That's not always good for the stock market. Back to the PowerPoint, which I just finished, so it's totally current data. On the weeklies, you can see that we've had big move-ups, but look at the red bar for this past week. Whether I look at the E-minis, the NASDAQ, the Dow, the Russell, and then the opposite green bars on the VIX and the dollar. So this market's not the same market it was 3 months ago. Rate steady mix. Some of the short terms were down, some of them were up, but all minimally moved, so I called it steady mixed. Here's a 10-year trickling up, the 30-year pulled back a few pennies. Rates have come off the bottoms. AD lines lead lower, Russell 2000 the left and Russell 1000 the larger caps on the right, and you could see the AD lines decisively turn down, as did the index. And if we look perhaps at a more followed one, the NYSE, we can see that it turned down, as well as every major market ETF is listed here in the upper left-hand corner, including TLT. Breadth drops, but is there more to come? Stocks above the 200-day drop below this line here, which has seen prior reversals in the 40s. Stocks above the 40-day SMA are down in the high 20s. So you have a lot of stocks that are above their 200 and less than their 40-day, but you have more stocks under their 200 than we saw last week. Now, the new high, new low went from in the high and close to a place you expected to reverse lower zone last week to a low and getting close to a place you expected to reverse higher. It doesn't have to reverse because it's getting close. If I look at the daily McClellan, you got a pretty extreme day on Wednesday, but didn't go and take down the February, March lows. And if I look at the weekly on as well, we failed the zero line reject. So the McClellan doesn't give me a lot of hope short term. Buckets. The buckets show that 80% of the stocks in the S&P 1500 are trading below the midline of their Bollinger Bands. It also says that 20% plus over on the left are trading below their bands. So that's a sign of an oversold market. It can just get a whole lot higher in a bear market. No evidence of a Hindenburg open. Of course, we haven't set new highs. We're not seeing the new highs, and frankly, we're not seeing a ton of new lows. Market tone, well, you had on Wednesday a series of kahunas to the downside, and if you look at the Woody indicator, all the major indexes are in red, as are all the major sectors. If I look at real-time Q review, over a 5-day window, all sectors are negative. 96% of industry groups are negative, and 92% of stocks are negative. It's very tough to make money to the long side when most things are down. If you look at Friday, Wednesday clearly was the worst day. Actually 21%. That's the 5-day right here. I'm sorry. If you look at Friday and Thursday, a little bit improvement over the last 1 to 2 days, but still the bigger part of the pie slice is red. We also saw rotation with energies leading the way, and that's despite oil dropping 10%. Financials have picked up, especially regional banks, and industrials also improved. Discretionary services, information, communication services all dropped, which is somewhere the big cap growth techs are. If I look at the top 3 sectors and I look at which industry groups are above 130, you got oil services, refining markets, regional banks, and railroads. So that's where some of the strength was this week. Canaries, simple word, broke down. This was the chandelier stop, which they went through decisively on Friday. If I look at know your news and earnings, it's possible that the Fed can help and we don't fight the Fed. I think it's interesting that the Fed meeting is their announcement will be on Thursday. Why is that interesting? Because we would have had a chance to see additional jobless claims and see the impact of the election. We may not know for weeks who won, and I think that is part of the concern hurting the market right now. So Fed meeting, jobless claims, and election are probably the most important things that are going to happen this week. But you also have a ton of earnings. Now, most of my earnings hit this past week, and they weren't rewarded. Amazon numbers, originally the stock was up $100 per share, and it ended up the day down close to $300 a share, or at least $300 below its high overnight. Facebook, Microsoft, Apple, people were punished with good and bad earnings. Shop blew their number away, but it wasn't as much of a blowout as before, and it got punished. So clearly a lot of challenges in this market. You've got to know your earnings and when they're coming. As I say here, it's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. I think I'm at a point now where holding out over earnings is probably not what I want to be doing, although I can use options to reduce that risk. As feared and as we discussed last week, we saw huge losses this week as we get ready for the U.S. elections. The major indices dropped more than 5% as the market was overcome with growth concerns, uncertainty, and negative price momentum. You could see the Dow was the worst at 6.5%, but all the majors were down over 5%. News negativity comes from, hold on, every once in a while, spell check doesn't work. It doesn't work when you don't spell wrong, you just pick stupid words. All right, so news negativity leads to election concerns, delayed stimulus. Due to election concerns, delayed stimulus, delayed vaccine result, mixed earnings, missing new home sales. European stock markets dropped 5% because of COVID shutdown. I took some heat, especially as my Amazon led to the downside. I was prepared for some of the drop. With Contras, I was short triple Qs, short the SPY, owned some VXS with short diamonds. Fortunately, I rolled up most of my in-the-money options last week, or 10 days ago, but my growth portfolio still took heat. You could see now the Dow's down 7, as is the Russell. The S&P is just holding on to a small gain on the year, and the NASDAQ leads with a 21% return. Markets do not go straight up or down, and a bounce might be close, but with the election looming on Tuesday, we may see continued weakness until a clear-cut winner is decided. The buy the dip market may be gone, so be careful. For me, there is no reason to be a hero. I will continue to protect my portfolio and will consider closing more of my remaining long positions, of which I have option positions that are worth a couple of bucks, not anything that's deep in the money, nor big equity positions that are not protected with puts. With this volatility, FOMO, you know who I'm talking to, is dangerous. So let's take a quick look at the markets. Spoiler alert, I'm not going to give you a lot of stocks to buy today. I might not give you any stocks to buy because I think that would be cavalier of me and not fair to you or your portfolio. If we start in major markets, our market analysis groups, Major Markets Plus, hit this. I will open up some of the market ETFs I like to look at. There are 28 of them. And let me set it to top-down view. Now, hopefully this isn't going to screw, well, no, I'm not going to change that now. When TBF ProShares is on top, hold on, let me fix this, followed by the dollar and volatility, high yield, gold and silver and commodities, that should tell you your markets got tanked. And they did. Small caps, NASDAQ, mid caps are on the bottom, as is the IBD 50. That's an interesting glitch. So let's open up the S&P 500. Now we're going to look at the cash indexes. And I'll probably go relatively quick through these because I think I've already told the story and what I looked at before. So I like setting mine, HGSI up, the designer in the upper left-hand corner, the warehouse view on top, and then I've got a daily and a weekly chart. And so what I see here is, as I said before, the S&P is kind of down to where it's reversed in the past. It has broken through the high of the year right here. It had a gap down early in the week. Here's the 200-day moving average. This here is a Phoenix, which is a follow-through day to the downside. I've got two kahunas to the downside. My weekly bongo has turned green. My daily bongo, excuse me, has turned red. My daily bongo is red. And ignore that one because that one does not exist. All right. So let me actually, this was an early version. Let me change this to, is this the one that has the right ones? Okay. Same picture I just changed around. The reason why I like this view is I've got my Hindenburgs on the top and we don't have one. I care more about the weekly than the daily bongo. I've given up on force from this perspective. I had a green candle low here, which we thought maybe Thursday would bounce, which it did, but it gave up some of the gains. These are the major indicators, the Bible gap up, squeeze, MOBO. Down here is a John Person indicator, which also forms in green below or red above. PMC market catcher, pocket pivots. This is a volume window, which you don't have volume on the S&P 500, but you have Eureka's in green, Phoenix's in red, which are by follow-through days to the downside in red and upside in green, and then Kahuna is in more volume below. All right, so natural place to bounce, probably the risk short-term is the 200-day moving average, and notice that we're coming down to, but not yet at the chandelier stop on the weekly. So could we drift down? Absolutely. You know, at this point, people who've been here before know I like to draw boxes. I mean, this is the optimistic box that we're in, but I just wonder if we're really in this, and are we going to come down and touch? So if we're going to live with the box, you know, what's the most likely thing probably going to happen this week? I'm concerned about this. I think it could do this too. And if I see this, I'm going to think it's going to be followed by this. So I'm going to be very careful. My concern is to the downside. This election volatility has me spooked. And I think we all felt that or saw that in our long positions this week. The Dow Jones Industrial Average, the big difference here is it's sitting on the 200, which is good. The fact that 200 sloping down isn't so good. Lots of pocket pivots to the downside, kahunas to the downside, just a very weak market. If I look at the Russell 2000, sitting just below the 50, so a little bit stronger. And if I look at the NASDAQ, you'll see another market that's sitting just below its 50-day moving average, although it did break down some on Friday. So this one doesn't look nearly as weak as the Dow or the Russell, but or actually the Dow or the S&P, there's a long way to drop on that NASDAQ. Within the NASDAQ, What about biotech? Nope, breaking down, getting close to potential bounce area. What about semiconductors? Rolling over but hugging the 50. What about IBD stocks, which probably reflect a lot of your portfolios and mine? Broken down. What about IBD innovator breakout stocks? Okay, broken down, excuse me. What about FANG stocks? Clobbered this week. You could see knifing through support. Where's the next level of support for these? Well, we might have support in here. Maybe you'll get an undercut of this in a rally, but that's a place that I'd be watching for. If I look at the dollar, cash is a position. The dollar's up over the last couple of weeks or a couple of days. If I look at volatility, you could see it spiked. It's already come back some. If I look at the metals, gold, really going nowhere, sideways down market. Gold miners, several of them popped up this week, but like gold, they're beat up and below their 50-day moving average. And then silver. So I wish I could show you something really optimistic and strong, but this is a pretty dangerous market right now. If you look at the weekly bar this week, oil was down 9.43%, at least the US oil fund was. Ugly. If we go to industry groups, hit my warehouse view, and then go to 2-day up, I had 10 groups that were to the upside. All right, well, that's something. The biggest one was cruise lines. That should tell you a problem right there. 2-day to the downside is 34. 5-day up, looks like 5, and 5-day down, 86. So this market is weak from a very short term and a longer term perspective. If you wanted to start going to the short side, you could look at these, right click on this, change to index group, and there you go. Number 1, Amazon. So Amazon looks horrible, doesn't it? We're in a weekly bongo. We've been in that for a while. We have closed again below the 50-day moving average. We're still about 100 points away or more, 150 points from where it fell back to in September. We're a long ways away from the 200-day moving average. We got a new person sell signal. We had some pocket pivots to the downside, kahunas to the downside, mobile breakdown from a squeeze. Amazon looks weak. Overstock, it's broken down. Could run a long way after it had this big run up. Netflix, broken down. Hgsi, broke down below the 50. BABA, hasn't really broken down yet. This has been clearly one of the leaders in this market, but it's off the 320 level. Wayfair, broken down. So if I was wanting to find a group to short in, I might look there. Application software. Some big winners here. Zoom. Well, it's pulling into its 50, so maybe I should let it see if it comes to rest there. But a breakdown below the 50, it could run down a lot. What else do we have in here? SAP, European technology company. It started the week off bad with, I think, an 8% down day on earnings. Let's see where it ended up. Excuse me, a 23% down day on earnings. Adobe, broken down. I like buying stocks in uptrends above the 50, not when the 17 is looping down below the 50. Salesforce, same. DocuSign, breaking down. Twilio, still above the 50, but in a short-term downtrend. Activision Blizzard, dropping down. Apps, I know Kathy and I, my neighbor Kathy and I both bought it down here. She bought it lower than me. I bought it around 27. She bought it at 26.50. But sometimes chasing these is not the right thing to do. So I'm going to have a very short lease. But boy, that broke down as well. The only reason I like this more than the others is look at the bottoming tail. So this group looks horrible. Renewable energy, these were big leaders. JKS. Oops. Is it done going down? I can't tell you that. Ask me Monday at 10 o'clock. Sunrun, a major leader, breaking down. Solar Edge. Now, Solar Edge at least has the 50 right underneath it, or 4 or 5% from here. Plug, pull back into the 50. Is that a buying opportunity, or is it breaking down? End phase. A little bit of a bottoming tail, but still breaking down here. So a lot to be afraid of to the downside. If I go look to the upside, here's the challenge that I see. Do you really want to go buy cruise lines? Carnival Corp. Nope, not me. Now let's see, probably pays a whopper of a dividend, 7.3%. Under accumulation because the Fed's going to let them start selling things out of, and starting ships out of Florida. But with Europe shutting down, really, how long is that going to last? And look at the earnings per share losses. Well, that's Carnival, Royal Caribbean, Norwegian. I can't buy any of them, even though it's got that multiple day kahunas in a row. So I'm not chasing these. Integrated oils, oils are up. Price oil's down 10%. There's a lot of bearish, a lot of bullish divergences on these stocks right now. Like, for example, I don't even have to put on a MACD. Chevron keeps going lower, but the person market catcher is going higher. All I need now is for me to see a buy signal, and I might want to chase one of these. I love convergence. Now, the problem is we're in a deep downtrend. We don't have good earnings, but we do in this stock pay a 7.3% dividend. Royal Dutch Shell, same thing. It did have a buy signal come in Friday, 8.4% dividend. BP, 14% dividend. Total 8% dividend. So just know why you're buying these. There's not a lot of growth in them, but maybe they're done going down. Precious metals and mining. The problem with these is they're below some of their averages. So this is trapped below the 50 and above the 200. Newmont Minings, you did have a green candle low. You had a person buy and a couple of kahunas come in. Be probably safer if you wait till it takes out the 50, but this made it to my buy watch list. American Barracks is further down in the pattern. Banks. Interesting that the regional banks here. Whoops, that's not number one. U.S. Bancorp is number one. I mean, these have now starting to retake their 200. It's probably reasonable. Look at this bottoming tail on this. Earnings are out to start nibble in this space. But for me, I can look at a lot of stocks. Here's PNC, M&T, SVB, the leader, CMA, 6% dividend, or I could just do this. KRE, I get a 3.5% dividend, I believe, 3.4%, and it looks like the stocks without the named risk. I could go through these, but if I tell you that I think there's a lot of great stocks here, I'd be fibbing. Oil services also showing that similar divergence, getting better here despite the price going down. But boy, you're bottom fishing here, and that's not the kind of trading that I typically do. I always give you a look-see and comments on my buy watch. So here's my buy watch. Some of these are frequent flyers. None of them are so exciting to me that I'm going to be going out and running to buy them on Monday. I mean, MTSI has looked good for a couple of days. It had a kahuna with a mobile breakout from a squeeze on Friday, but I'm waiting for it to take out its chandelier stop. Garmin in a good market. Boy, a couple kahunas in a row. Pocket pivot, John Person sign, coming off a mobile breakout from a squeeze and a weekly bongo, and a weekly high close doji. So I like Garmin a lot. Again, I hate the market, and I don't know how much long exposure I want to have. Cowen Group has got great earnings, breaking out, held the breakout, probably because of the earnings growth turnaround play, dinky little dividend. Quidel, I think 2 weeks ago I said, or last week, it's a great stock to short and a great stock to be long. Long because of the earnings per share growth, and short was because it was clearly heavy here. I think it's getting ready to go again. So there's my list to the long side. I would give this list a C+. There's some nice stocks on it. The problem is the market's so bad, and with a market like this, I'm going to be careful. If I look at my shorting list, just think big NASDAQ stocks. C is I actually have a long position, which I covered with some puts on Friday to protect it. It's still above the 50, but you had a mobile breakdown from a squeeze, a new John Person sell, and a kahuna to the downside. Zoom we looked at. Tesla has broken down below the 50. Roku, Square, others are getting into the Bitcoin, so that put pressure on its price. FedEx probably has some support at the 50. UPS has broken through it. Amazon we looked at. Mercado Libre, the eBay of South America, has the 50 underneath it, but earnings per share growth coming to a halt. It's an expensive stock. All right. I mean, great companies. Dexcom, bombs below. Intuitive Surgical. Nope. NVIDIA. Is it a great time to buy, or is it's on its way to the 200? A lot of fear in this market, and it's hard for me to be overly bullish. I do think after what I saw Friday and the recovery that maybe we do bounce early on. I'm going to continue to be careful. I'm going to continue to take more profits off, and I'm going to play with ETFs, and I'm going to play small ball because I don't want to give up all my profits. I don't want to give up any profits, and neither should you. On that note, I'm going to say goodbye. Have a wonderful day. Thank you for joining me, and enjoy the rest of your weekend. Goodbye.